Check the shit.
A financial statement is an official company document that examines all of the company's financial information. The main objective of the financial statements is to provide information and understand the financial aspects of a company. Preparing the financial corporate statements is just as important as the financial decisions. So according to Hemstor's John, the financial statements are a collection of information according to logical and consistent accounting procedures. The aim is to convey an understanding of the financial aspects of a company. It can represent a position at a point in time, as in the case of a balance sheet, or it can show a performance of activities over a period of time. Financial statements are the summary of the accounting process and provide useful information for internal and external parties. The balance sheet reflects the assets, liabilities, and capital as of specified dates, and the income statement represents the results of operations during a specified period. John Angier defines financial statements as a business enterprise accounting records. Financial statements generally consist of two important statements. One, the income statement or profit and loss account, and two, balance sheet or the position statement. In addition, the company also prepares some of the other parts of the statements that are very useful for internal purposes, such as statement of changes in owner's equity and statement of changes in financial position. So now, let's discuss the income statement. The income statement is also known as the profit and loss account and reflects the operating position of a company during a specific period. It usually consists of one accounting year, determines the overall operational performance of the company, like the total revenue generated and the expenses incurred to generate that revenue. The income statement helps in determining the gross profit and net profit of the company. Gross profit is determined by the preparing of commercial or manufacturing account, while net profit is calculated by dividing this by the sum of sales and profits.
Good day everyone, my name is Daslin Pancho, and for today's video, I am going to explain the position statement and the statement of changes in owner's equity. Any business owner, investor, or part of management, the quickest path to peace of mind is knowing the numbers of your business. One of the best ways to keep an eye of your finances is through a statement of financial position, where most commonly prepared basic financial statement is present. Then, statement of changes in owner's equity, which covers the net profit or loss. Position statement. Statement of financial position, also known as the balance sheet, gives the understanding to its users about the business financial status at a particular point in time by showing the details of the company's assets along with its liabilities and owner's capital. It is one of the most important financial statements, which reports the firm's financial position at a point in time. In other words, it summarizes a business financial position and acts as a snapshot of events at one point in time. It comprises three major elements, namely assets, liabilities, and shareholders' equity. Assets are the resources owned and controlled by the business. Assets are further classified into two: current assets and non-current assets. Current assets refer to those short-term assets which can be efficiently utilized for business operations, sold for immediate cash, or liquidated within a year. It comprises inventory, cash equivalents, marketable securities, and account receivables, while non-current assets are long-term assets, both to use in the business, and their benefits are likely to accrue for many years. These assets reveal information about the company's investing activities, and it can be tangible or intangible. Examples include property, plant, equipment, land and building, bonds and stocks, patents, and trademarks. Now, let's talk about liabilities. Liabilities are the amount of business owing to its lenders and other creditors. Liabilities are further classified into two: current liabilities and long-term liabilities. Current liabilities are the payables which are likely to settle within 12 months of reporting. They're usually salaries payable, expense payable, short-term loans, and etc. While long-term liabilities, also known as non-current liabilities, refer to a company's financial obligations that are due for over a year from its operating cycle or the balance sheet date. Now, let's talk about the shareholders' equity. The shareholders' equity, which is the residual interest in the net assets of a business. The net asset on the balance sheet is the amount by which your total assets exceed your total liabilities and is calculated by simply adding what you own or the assets and subtract it from whatever you owe or the liabilities. It is commonly known as the net worth that remains after deducting from its liabilities. Now, here's an example of position statement. Now, let's talk about the statement of changes in owner's equity. A statement of change in equity, also referred to as statement of retained earnings, is a business financial statement that measures the changes in owner's equity throughout a specific accounting period. It covers the following elements of net profit or loss, dividend payments, equity withdrawals, effect of accounting policies changes, effects of prior accounting period corrections, and accumulated reserves and retained earnings. The purpose of a statement of changes in equity is to furnish shareholders with information that can further inform their investment strategy. It can be used to identify the par value of common or treasury stocks, clarify retained earnings, and strengthen investors' trust in your company. Here's the example of statement of changes in owner's equity. Thank you.
Hi, today we will going to talk about the statement of changes in financial position. So without further ado, let's get started. Income and position statement only show the financial position and cannot measure the actual position of the financial statement. The statement of changes in financial position helps to understand the changes in financial position from one period to the next. It includes two important components. First is the fund flow statement, which includes changes in working capital position, and the cash flow statement, which includes the changes in cash position. So statement of changes in financial position shows a business's net cash flow over a certain time period. It also called the sources and uses of cash statement because it shows where the cash came from and went to. Now, let's talk about the types of financial statement analysis. So first, what is financial statement analysis? Financial statement analysis is the process of reviewing and analyzing a company's financial statement in order to make more profitable economic decisions in the future. So financial statement analysis is also required to understand the financial positions during a specific period. According to Myris, financial statement analysis is largely a study of a relationship among the various financial factors in a business as disclosed by a single set of statements, and a study of a trend of these factors are shown in a series of statements. So financial statement analysis can be divided into two categories: the on the basis material use and on the methods of operation. On the basis material use. So based on the material use, financial statement analysis can be classified into two major types, such as external analysis and internal analysis. So first is external analysis. Outsiders of the business concern do normally external analysis, but they are indirectly involved in the business concern, such as investors, creditors, government organizations, and other credit agencies. External analysis is very much useful to understand the financial financial and operational position of the business concerned. External analysis mainly depends on the published financial statement of the concern. This analysis provides only limited information about the business concern. Next is the internal analysis. The company itself does disclose some of the valuable informations of the business concern in this type of analysis. This analysis is used to understand the operational performances of each and every department and unit of the business concern. Internal analysis helps to take decisions regarding achieving the goals of the business concern.
Good afternoon everyone, I'm Joshua Malina and today I will discussing about horizontal and vertical analysis. So what is horizontal analysis of the financial statements? So it is a percentage analysis of changes in comparative financial statements. So when horizontal analysis, so we are comparing it on the basis of time. So gina-assess nato ang percentage of change. So that's why our formula, that will be the amount for the later period divided by the amount at the earlier period, or maingon nato siya as the base year divided by earlier period or base year. So example, if you are comparing the amounts for 2020 with 2019 financial statements, so formula is tagpila ang amount sa 2020 minus tagpila nung 2019 divided by amount for 2019. So our base year is 2019. So now let's go to the problem. So let's say this is financial statements. So look at this table. For year 2019, there is also year 2020 for our solution. He already has a percentage. Okay, let's see the cash. The change is said to increase of 5%. So how did we get 5%? What we did is, so katong 2020 diba, is amount sa cash kay 210. So katong 2019 pod kay 200. So 210 minus 200, so 10 divided by this amount. So diba yung this amount kay yung cash for the year 2019. So 10 divided by 200, so the percentage of change is 5%. So we okay in the horizontal analysis. So next is vertical analysis. So it is a percentage analysis used to show the relationship of each component to the base total within the single statement. So also called common size financial statements. So peso amounts are translated to percentages indicating the relative sizes of an item in proportion to the whole. So para asa ang vertical analysis? So it is ideal for comparing firms with different sizes. So one is for balance sheet. So each item is converted into percentage by dividing it by total assets. So 2 is for income statement. So each item is converted into percentage by dividing it by net sales. So this is the table of balance sheet for 2020. So pag ito turn ninyo ang percentage, your denominator must be total assets. So ang assumption nato kay 100%. So I will confirm this the next table. Pay attention, total assets are 100%. So the total liabilities and shareholders equity same ra gihapon 100%. So that's why for cash, ang gihimo nato kay 210 divided by 450, so that is 47%. And then for our liabilities, so again 80 divided by 450, so that is 18%. Next is income statement. So there are certain things na kailangan nato pansinon nga important for this problem. What if gain, how we treat the gain on income statement, and we use vertical analysis? Tanawin ninyo sa next table. Diba ang net sale mauto ang 100% and the cost of goods sold, the bank effect and cost of goods sold decrease sale. So that's why negative, so katong gross profit kay 59%, Tapos ka ng mga expenses, di ba tanan sila kay minus. It makes sense, expense, administrative expense, minus 7%, 12%. So, tanawan ninyo ang gain on sale equipment. Positive siya. Kaya diba, it increases our income. So, ang gihimo nato, 3 divided by 123 pesos and 86 centavos. So, that is 2% positive. And then, tanawin ninyo, interest expense minus income tax expense negative. So, our net income is 24% of our sales. So, mao to siya ang vertical analysis or income statement. So, that's it for my report. Thank you.
Good day everyone, my name is Virginia Bacalso and these are the types of financial statement analysis. First is a comparative statement analysis. A comparative statement is a document used to compare a particular financial statement with prior period statements. Previous financials are presented alongside the latest figures in side-by-side columns, enabling investors to identify trends, track a company's progress, and compare it with industry rivals. Examples of comparative analysis include pattern analysis, identify pattern of behavior or chance to make predictions, or enforce probability. Data filtering, analyze group data to identify and extract data subsets. Decision tree, analyzes the advantages and disadvantages of a decision through its influences and risks. So next is a comparative balance sheet. So what is the comparative balance sheet? A comparative balance sheet is a statement that shows the financial position of an organization over different periods for which comparison is made or required. The financial position is compared with 2 or more periods to depict the trend, direction of change, analyze, and take suitable actions. So how do you analyze comparative income statement? First is comparing sales with cost of goods sold. Changes in sales in a given accounting period should be compared with the changes in the cost of goods sold for the same accounting periods. Second, change in operating profits. And lastly, the profitability of a business. Comparative statement of profit and loss. So, the comparative statement of profit and loss is the horizontal analysis of statement of profit and loss, which shows the operating result for the compared accounting periods, changes in the data in terms of absolute amount and percentage from one period to another. So the main categories that can be found with the P&L or the profit and loss includes first, the revenue or the sales. Secondly, is the cost of goods or cost of sales. Third, selling, general and administrative or SG&A expenses. Fourth is marketing and advertising. Fifth is technology, research and development. Sixth is the interest expense. Seventh is the taxes. And lastly is the net income.
Good day everyone, I am Eliza Manila and I'm going to tackle about trend analysis. Trend analysis. The financial statements may be analyzed by computing trends of series of information. It may be upward or downward direction which involve the percentage relationship of each and every item of the percentage with a common value of 100%. Trend analysis helps to understand the trend relationship with various items which appear in the financial statements. These percentages may also be taken as an index number showing relative changes in the financial information resulting with a various period of time. Example, you want to calculate the trend percentage for 2017, 2018, and 2019. Your base year would be the year 2017, so you have to replace the value under that year with 100%. For instance, your company had 2,360,102 pesos, 3,126,528 pesos, and 3,206,100 pesos in cash in the year 2017, 2018, and 2019 respectively. Your base year balance is 2,360,102 pesos. You have to divide 2,360,102 pesos by itself and then multiply the outcome by 100 to get 100% for the base year trend percentage. The trend percentage for the base year is always 100. To calculate the trend percentage for 2018, you have to divide 3,126,528 by the base year, which is 2,360,102, and the result is 1.32. And then multiply it by 100, the result is 132, and that is your trend percentage for 2018. Now, to get the trend percentage of 2019, you have to divide 3,206,100 by the base year, which is 2,360,102, and the result is 1.358. And you have to multiply 1.358 by 100, and the result is 135.8, and that is your trend percentage for 2019. Note, if the trend percentage is greater than 100%, it means the balance in that year has increased over the base period. However, if the trend percentage is less than 100%, it means the balance has decreased below the base year level in that particular year.
Good day everyone, I am Leami Monteso. For today's discussion, we will talk about common size analysis. Common size or vertical analysis is a method of evaluating financial information by expressing each item in financial statement as a percentage of a base amount for the same time period. A company can use this analysis on its balance sheet or its income statement. A balance sheet summarizes the company's assets, which are things that it owns that have value, and liabilities, which are amount it owes to others, and its equity, which is an owner's investment in the business. An income statement shows the company's revenues, which is the amount of money it made by selling its goods and services, and its expenses, which is the amount of money it spent to earn its revenues. So the formula used in common size analysis is common size amount equals analysis amount divided by base amount times 100%. The base amount will change depending on whether the company is completing its analysis on the balance sheet or the income statement. If the company completes its analysis on the balance sheet, then the base amount will be total assets or total liabilities and owners or shareholders' equity. If the income statement is used, the base amount will be net sales. For instance, let's assume that Sam's cash balance is 75,000 pesos and his total assets are 1,835,000 pesos. If we apply common size analysis, the common size amount would be analysis amount divided by base amount of total assets times 100%. So it will be 75,000 divided by 1,835,000 times 100% is equal to 4.1%. Therefore, 4.1% of Sam's total assets are made up of cash.
Good afternoon everyone, I'm Michelle Late and I am here to define what is fund flow statement and cash flow statement. So first, fund flow statement, also called as statement of sources and uses of funds, is one of the important tools that is used in many ways. So according to Institute of Cost and Reverse Accounts of India, the fund flow is defined as a statement prospective or retrospective, setting out the sources and application of the funds of an enterprise. The purpose of the statement is to indicate clearly the requirement of funds and how they are proposed to be raised, and the efficient utilization application of the same. So fund flow statement in simple words is the sum of all cash inflows or outflows from and into different financial assets and is often measured on a monthly or quarterly basis. Second, cash flow statement. So a cash flow statement is a financial statement that provides aggregate data regarding all cash inflows the company receives from its ongoing operations and external investment sources. Also, it includes all cash outflows that pay for business activities and investment during a given period. In addition, cash flow statement provides a summary of operating, investment, and financing cash flows and reconciles them with changes in its cash and cash equivalents such as marketable securities. The difference between the two will be discussed by Emily Santillan.
Good day everyone, I'm Emily T. Santillan and I have been given the task of explaining how cash flow and funds flow statements differ from one another. Additionally, we'll cover how to create or prepare cash flow and funds flow statements. Let's begin. A cash flow statement is a sort of financial statement that provides comprehensive data on all of the cash inflows a company experiences from ongoing operations and outside sources of investment. It also includes any cash withdrawals for investments or business expenses that were made within a given time frame. A funds flow statement, on the other hand, is a statement that shows the inflows and outflows of money. It describes the financial options and their application during that particular time. You can therefore look at what led to a change in a company's financial situation. Since cash flow statements provide insight into different areas a business used or received cash during a specific period, they are important financial statements when it comes to valuing a company and understanding how it operates. A typical cash flow statement comprises 3 sections: cash flow from operating, investing, and financing activities. Now, how to create a cash flow statement? The first step in preparing a cash flow statement is determining the starting balance of cash and cash equivalents at the beginning of the reporting period. This value can be found on the income statement of the same accounting period. Once you have your starting balance, you need to calculate cash flow from operating activities. This step is crucial because it reveals how much cash a company generated from its operations. Now, after calculating cash flows from operating activities, you need to calculate cash flows from investing activities. This section of the cash flow statement details cash flows related to the buying and selling of long-term assets like property, facilities, and equipment. Keep in mind that this section only includes investing activities involving free cash, not debt. The third section of the cash flow statement examines cash inflows and outflows related to financing activities. This includes cash flows from both debt and equity financing, cash flows associated with raising cash and paying back debts to investors and creditors. Once cash flows generated from the 3 main types of business activities are accounted for, you can determine the ending balance of cash and cash equivalents at the close of the reporting period. The change in net cash for the period is equal to the sum of cash flows from operating, investing, and financing activities. This value shows the total amount of cash a company gained or lost during the reporting period. A positive net cash flow indicates a company had more cash flowing into it than out of it, while a negative net cash flow indicates it spent more than it earned. Moving on, how do you create a fund flow statement? First, we'll discuss the statement of change in working capital format. In this format, there are 2 parts: current assets and current liabilities. We will take existing assets and current liabilities from the balance sheet on March 31, 2019 and March 31, 2018. Then calculate net working capital by deducting the current liabilities from current assets. After that, compare the net working capital of both years and find out changes in working capital. As the example demonstrates, net working capital as of March 31, 2019 and March 31, 2018 is 12,000 and 5,500. Therefore, for the current year, which is March 2019, the increase in working capital is 6,500. After preparing the statement of change in working capital, now we need to prepare a report of funds from operations. In this statement, we will take the profit or loss from the profit and loss account per current, but then we need to adjust profit or loss. We prepare profit and loss accounts on an accrual basis. However, in these non-cash expenses like depreciation, bad debt, and any expenses written off are also considered for getting the actual profit or loss. We will add back or less, as the case may be, those non-cash expenses, and we will get the cash profit or loss. we have assumed the current year's profit is 20,000. Then we have identified non-cash items which have been deducted in profit and loss account or current, which is 3,230, which is now added back to the current year's profit. As a result, a non-operating item added in the profit and loss account of 120 has been reduced from the current profit. After adding and deducting non-cash or non-operating items, we will reach the position in which fund flow from operations can be calculated, which is 23,110. Finally, we will prepare the fund flow statement. This statement will find out the sources and application of funds. In the previous example, we have seen that increases in working capital are 6,500, considered as applications of funds, and the fund from an operation is 23,110, considered a source of funds. Suppose we have issued share capital in the market amounting to 5,000 pesos, considered a source of funds. A ranged source of the funds is used to enhance working capital and purchase fixed assets. In conclusion, cash flow is more common and more utilized among investors as compared to fund flow. However, if we examine them separately, we will discover that both have important functions. By clearly displaying how much money is coming into and going out of a firm, cash flow benefits the company, its investors, and future investors. However, a fund flow statement aids a business in creating a capital budget and take the required actions with regard to the particular matters that have an impact on the company's sources and uses of funds.
Hello everyone, I am Jala Palmero and I am going to tackle ratio analysis. So, what is ratio analysis? Ratio analysis is a commonly used tool of financial statement analysis. Also, according to Andrew Blumenthal 2022, ratio analysis can mark how a company is performing over time while comparing a company to another within the same industry or sector. Ratio analysis may also be required by external parties that set benchmark often tied to risk. Ratio is a mathematical relationship between one number to another number. Ratio is used as an index for evaluating the financial performance of the business concerned. So, an accounting ratio shows the mathematical relationship between two figures which have meaningful relationship with each other. And ratio can be classified into various types, and those are liquidity ratio, activity ratio, solvency ratio, and lastly, profitability ratio. So first, let's talk about the liquidity ratio. So what is liquidity ratio? Liquidity ratio is also called a short-term ratio. This ratio helps to understand the liquidity of the business, which is the potential ability to meet current obligations. So, liquidity ratios measures the company's ability to pay off its short-term debts as they become due, using the company's current and quick assets. Liquidity ratios includes the current ratio, quick ratio, and working capital ratio. This ratio expresses the relationship between current assets of the business concerned during the particular period. So the following major liquidity ratios are: first is the current ratio. So current ratio, any current ratio lower than 1 implies the negative performance of that business or individual. A current ratio below 1 is indicative of one's inability to pay off the present time monetary obligation with their assets. So the formula of the current ratio is current ratio is equal to current asset divided by current liabilities. So the second is the quick ratio. So quick ratio determines a company's current available liquidity. So the formula of quick ratio is equal to current asset minus inventory divided by current liabilities. So next is activity ratio. So what is activity ratio? Activity ratio is also called turnover ratio. This ratio measures the efficiency of the current assets and liabilities in the business concerned during the particular period. Also, according to Will Canton 2020, activity ratios may be utilized to compare two different businesses within the same sector, or they may be used to monitor a single company's fiscal health over time. This ratio is helpful to understand the performance of the business concerned.
Hi everyone, good day. Today I will discuss to you the assigned topic, which is the solvency ratio and profitability ratio. So, who have an idea of solvency ratio? So, what is solvency ratio? So, solvency ratio is a key metric used to measure an enterprise's ability to meet its long-term debt obligation, and it is used to often by prospective business. Solvency ratio indicates whether a company's cash flow is sufficient to meet its long-term liabilities, and thus its measure of its financial health. An unfavorable ratio can indicate some likelihood that a company will default on its debt obligation. So it means the solvency ratio is examine a firm's ability to meet its long-term debts and obligations. So, in other terms, solvency ratios are often used by prospective lenders when evaluating a company's creditworthiness, as well as by potential bond investors. Solvency ratios and liquidity ratios is both measure a company's financial health. But solvency ratios have a longer-term outlook than liquidity ratios. So let's proceed to profitability ratios. So what is profitability ratios? So profitability ratios are class of financial metrics that are used to assess a business ability to generate earnings relative to its revenue, operating cost, balance sheets, assets, or shareholders' equity over time using data from a specific point of time. So it means profitability ratios assess a company's ability to earn profits from its sales of operations, balance sheet, assets, or shareholders' equity. So profitability ratios indicate how efficiently a company generates profit and value for shareholders. So there have examples of profitability ratios. So the example here is profitability ratios are one of the most popular metrics used in financial analysis, and they generally fall into two categories: the margin ratios and return ratios. So that is the two examples of profitability ratios. So aside from that, guys, I will show you the solvency ratio formula. So I will explain to you. If you examine carefully, you will notice the numerator comprises the entity's current cash flows. So, while the denominator is made up of its liabilities, thus it is safe to conclude that the solvency ratio determines whether a company's cash flows is adequate to pay its total liabilities.